Hey, it's Cody A here. In this video, I'll explain to you why I think selling put options is much better than buying stocks outright. And I'll break this video down into 3 parts. The first part, I'll demonstrate on the benefits of buying the stocks outright. The second part, I'll show you on how do you sell put options on stocks. And in the third part, I'll talk about a strategy I use to sell put options on stocks and continue to make money even if the stock price continue to go down. So if you want to learn how I do that secret strategy, stay until that part. And let's get right into it. So let's talk about buying the stocks outright. I will be using Apple stocks as an example. If I buy 100 shares of Apple on my screen here, let's go to Apple. We're looking at Apple today is May the 18th. Apple is trading at $175.26, right? So if we look at the chart here, we look at the past 5 years of Apple stocks. Past 5 years. It has been trading as low as $30 in 2018, and right now is $175. So that's about 5 times of the stock price. So if you buy in 2018 and you sell it today, you make 5 times. So that's about 600% return. Now, if you look closer right now, Apple is at an all-time high, right? It hit this price once in early 2022, and again in May 2022, and then again in July 2022, and now it finally come back up. So the stock price has been going sideways. So if you buy the stocks outright around the end of December 2021, you will not be making much of the money. Yes, you'll be making some dividend, but you will not be making any money from the appreciation. So if you decide to buy 100 shares of Apple right now, you will get paid a dividend on the left-hand corner, a dividend yield of 0.53%. So that's, go and do that, hit buy. I say quantity, I say I want to buy 100 shares up top here. And then, I choose limit. Doesn't really matter, we just choose market so we get filled right away, right? So on the top left corner, if I swipe right now, I will be buying 100 shares of Apple, $175.24. Okay, so swipe right, here we have it. We bought 100 shares of Apple at $175.24, and we'll lock in the price at the all-time high, getting paid a dividend yield of 0.53%. Now let's get into part 2 where I explain why I think selling put options is better than buying stocks outright. And wait, if you have no experience in selling option, you have to watch this video up top. That's my most viral video on my channel. It will explain everything about selling options, and you come right back to watch this video. So now I'm gonna continue as I assume that you already understand the basics of selling options. And you understand that when you sell a put options on a stock, that means you agree to own a stock you wanna own anyways at a cheaper price, and you get paid doing so. And when you sell the put options on a stock, you decided to agree to own the stock at a cheaper price. That means if you ever have to buy that stock, you inherently have a buffer set in place. So you will continue to make more money if the stock stays the same, goes down, or even go up. So let's get right into a live example on selling put option on an Apple stock to show you how. So I pick Apple here and I go to option. So I go, not just say randomly, I go 42 days out for expiration day. It's just like an insurance contract. You sell, now they're an insurance company, you sell the contract for 42 days, you get paid some money as a premium. Okay, so right now Apple is at around $175. Before I go sell that, I go look at what's the Apple price, see if there's clear support and resistance. I go to 1-year chart. Okay, we're about one all-time high, but the next, the last support is about, let's say 170. Now I decide on my strike price, which is the price I decide to own Apple at. Go back to the option, and 42 days, still the 42 days, I go to 170. So you will see 2.5 and 2.55. This is how much money I would get paid if I decide to sell the put option on Apple at the strike price of $170. If I pick 170, you gotta be very careful to scroll up here and make sure we're selling but not buying. So we hit this refresh button. Now selling, and we hit order. And from what you can see here is that we decide to own Apples at $170 if Apple is below the price of $170 by June 30th. Okay, and what's the results for that? We get paid $2.55. And because every time we sell a put option, we are agreeing to buy 100 shares of Apple. That means this $2.55 we get paid as premium has to be timed by 100. So in total, we get paid $255. So we scroll down here. Okay, quantity 1 contract, order type, limit price, that's just pit mid, most likely will get fill. Day enforced day, because right now it's at 4:32 p.m. Eastern time, the market already closed, we probably won't get fill. But just say display size, we don't care about that. Price management algo, turn it on and swipe right, okay? And that's it. So now that we just sold 1 put options on Apple with the strike price of $170, instead of buying the stock price outright at $175, we agreed to own 100 shares of Apple $170 if Apple stock price dropped below $170 by the end of expiration day. And if it stays above $170 by the expiration day, we just get to keep all the premium of $255. So if I'm obligated to buy 100 shares of Apple at $170 down the road, my true cost of owning Apple stocks will be around $167.5 instead of $170 because of the premium of $255 I get paid. And $167.5 is a lot lower than $175 when you buy the stocks outright. Now, if you're someone thinking that the market is about to crash, what if Apple continued to go down? Would I still be making money? Don't worry. Our said and done strategy is to set up to sell options in a way that you'll make money whether the market goes up, down, or sideways, and you don't even have to pick stocks. So check out the link in the description to find out how. Now let's get into part 3, where you don't want to buy the stocks outright and you still think selling put options on individual stock is risky, but you still want to make passive income. You can sell a credit spread, specifically a bull put spread, and I'll demonstrate that on my phone right now. Okay, let's get right into it. We're gonna use the same ticker, Apple. The stock price is still around $175. Now we're gonna go to option page and we're gonna use the same expiration date, that's 42 days out, right? And in part 2, we sold a put option at $170. So you're gonna make sure, turn to sell. Now, we gonna buy a put option at a lower strike price. That's in this case, let's pick 165, make sure it's buy, but not sell. So why do you do that, Cody? You get paid $255 when you sell the put option 170, and you now go buy a put at 165 and pay $144, right? So net, we're gonna get paid on the bottom right around $96. So Cody, why do you do that? The reason we do that is because we reduce the amount of cash flow we receive. However, we also cap the maximum amount of loss we can incur. And that is the difference between 170 and 165, which is 5 times by the 100 shares. So the maximum loss you can incur is $500. Now, the reason why I tell you why it's great is because I'm not trying to incur this loss. So if Apple stock price go below 165, what I can do is I can actually sell the put I bought. When I bought it, was $154 I paid for. The lower the stock price goes, the higher the premium it will become. So that means I bought it for $154. If it goes below $165 or start getting higher, I can buy it back at 3.0, 4.5, whatever that is, and profit at the difference. So that means I'll buy it back. So we'll cancel that one, make profit of a few $100. Then I'll continue to keep my put of 170 because I still want to own Apple shares. And I remember I get paid early on with $255, and my cost of owning it in part 2 is $167.5. Now because of that put I sold, right? And I make a few $100. The cost of ownership of this 100 shares of Apple is actually lower than 167.5. It could be 165 or 163. And there you have it, guys. If you have any question about selling put options, put it in the comment section below. I'll see you on the next video. Say yay.